Hey everybody, Preston Brent here with our weekly roundup brought to you by our trader user group. This is for the trading week ending Sept 14, 2018. Well, the market fundamentals still support a very strong U.S. Economy. We've seen strong economic numbers coming out over the past several weeks. Everything from industrial production to consumer prices, uh, coming in very strong, consumer confidence, small business confidence, all coming in at 10-year highs, over decade highs. And in addition, we've got really strong corporate earnings. They've been up year over year, quarter over quarter, very good, very strong. We've got Q3 earnings coming up very soon. Those are also expected to be fairly strong. So it's not a surprise that we've seen the markets moving higher, regardless of some of the risk, geopolitical risks that are floating around out there around this planet. Primarily the trade tariffs, it seems to be on everyone's top of mind. Certainly when there's a news headline that hits, the algos fire off, like we saw this past week with China and the 200 billion when news hit the news wires that Trump gave the green light to impose 200 billion in tariffs. The market sold off, but then quickly regained it. Most of the markets believe Trump's not going to do anything before the midterm elections. He's using it as a posturing tool. Not really sure if that's true or not, but certainly the price action seems to indicate at this time that's what he's doing. We've also seen this huge divergence between the S&P, the US markets, and primarily the Asian Pacific markets, which tend to get hit harder with any talk of trade tariff. I mean, generally, most of the Asian Pacific markets made up of the Morgan Stanley Composite Index, the MSCI, which is a real popular index, kind of composes or is comprised of Japan and China, South Korea, Taiwan, Australia primarily. It is off over the past 12 months, not this year, but just for the past 12 months. There's a net 17 percentage point performance delta between the two, meaning the US has outperformed Asia Pacific markets by 17%. Now, this is not going to last, folks. This trend is unsustainable. And it's going to change. The big issue is how is it going to change? Some economists, me included, and I'm not anything but an economist, I'm more a trader. But I do love when you've got market imbalances out there where we want to take advantage of that imbalance, meaning I think the markets will come a little bit back more into balance. So that basically means that over the next 12 months, I could see the US and the US markets underperforming on a relative basis, probably the Asian Pacific area and emerging markets, because emerging markets have also taken it in the shorts as well. Now, if we've got a full tilt boogie trade war, then all bets are off. We could see emerging markets, primarily the Asia Pacific area, also continue to go down. But I think on a relative basis, the S&P will go down more on a percentage basis because they priced in more of the damage in the Asian Pacific area and emerging markets than elsewhere. We're also seeing currencies bounce around a pretty good little bit too, starting with Turkey's lira and then the rand in South Africa. I used to spend a lot of time down in Brazil, lived down there for about a year doing some consulting work in the financial markets. And the Brazilian real is at 420 to the dollar, which I don't think I've seen that in the past 10, 15, 20 years. Really crazy. So we've just got some dislocation in emerging market currencies. We're seeing also a lot of the stimulus. A lot of people don't realize that still 25% of the world's global economy still has negative interest rates. We're still stimulating over in Europe, Great Britain, to some extent China, Japan. The US is the only one that's been pulling back. Now, keep in mind that after the 07, 08 debacle, when we bottomed in March of 2009, the US was the first to belly up to the bar and start stimulating the economy. I believe that was one of the reasons why we got ahead of the curve here in the US, right or wrong, whether you believe in it or not. The US started stimulating sooner, started inflating balance sheets quicker. It took several years before Europe even bellied up and decided to do some of that stuff. In fact, a year or two after, they actually raised rates until they realized they erred of their way and backed off. So that's why they're still in the stimulus mode while we're pulling back. So that's created this divergence in the global growth story. 2017, everybody was stronger, but the US was stronger relative to everybody else. You probably heard in 2017 a lot of talking heads on TV talking about global growth, the global growth story. Well, now where are they? I think they're hiding under a rock, or they went deep sea fishing and they haven't come back yet. Um, because there is no global growth. The only area where we're seeing growth is in the US economy. Now, how much longer can this continue? I still think we have a little bit more upside left in us, but I think over the next 12 months, as I said, the growth in the US on a relative basis is going to be less clearly than it's been since the start of 2017 or even 2018 for that matter. What I've got on the screen here is the daily chart of the E-mini S&P 500 futures. You can see as we finished Friday, we came within 25 ticks of making new all-time highs. You can see that candle here on the futures. Let me just widen it out for you so that you can really see it a little bit better. You can see this candle here. I mean, we just came right up and we made 29.1725. All-time high is 29.1750. And then the markets pushed it right back down. I would not be surprised to see us and see momentum continue to make new highs here and then eventually come back down into this 28.75 area. Maybe 28.63 was where our former all-time highs were before we spent a week or so breaking out. Okay. So we're setting up for another divergence here should it roll lower. I would ideally like to see a little bit of a run up higher. And then a rollover, I think we can get better short prices up higher than where we are right now. But clearly the momentum is going this way, okay, from the lows that we had in this slight little dip that we had back in the beginning of March. When we start, or beginning of March, when we began September, you can see from the 4th, 5th, 6th, and 7th, Tuesday, Wednesday, Thursday, Friday, the four trading days of September were all met with red candles. And then to close out this week, we actually closed just a little bit higher than the highs made last week. So we were a little bit higher here, okay, from to kick off September. Now, keep in mind, September traditionally is a down month for the S&P and an up month for volatility. Although we saw vol here for this week actually come down to 1207. So we've got volatility is still lower than I feel comfortable with, given some of the potential risks that could move price action around. In fact, if we look at volatility, I think we've got historical volatility, the lowest we've seen going back of about 55, 57 days since the beginning of January. We've had the S&P has not moved up or down more than 1% for 57 days. And that last time was when we had that correction back in late January, early February. IV or HV, historical volatility, is really low compared to implied volatility. So that shows that the markets are getting a little bit nervous with this run up here. And when you see a big disparity between historical volatility and implied volatility, that means the volatility that's actually occurred is very low. And the volatility implied for future is higher than where we are right now. So that does tend to show that we're starting to get a little bit of an elevated put call ratio or a skew. But that's for our members. We'll go through this Sunday evening for our weekly market watch. If you're not a member, I highly encourage you to come in and join us. We're having a fun time this year. We got some trades that we're running. And by the way, we got a different way of trading volatility than the rest of the crowd. We're the contrarians in the group. It's got a 90+% probability of success. We just put one on and took it off a few days ago or a week ago, made money in it again. So if you're interested, come on in and check us out. So this is the E-mini S&P 500 futures. If we look at the Dow, okay, now it was down by just 2 points on Friday. But even with all of the talk of Chinese trade tariffs. The Dow has taken out its prior pivot high that it just had a hard time doing, 25,813. And you can see here that we actually took out another high that we made at the end of August. So the Dow is still trying to move up towards 26,684. I believe the Dow is not going to make new all-time highs until we resolve this difference with the Chinese tariffs, because should those 200 billion in tariffs go on, we're going to see the Dow come down at least 200 or 300 points, probably on the day that it's announced if it becomes official. Remember, last week, all the tweet was you've got the green light to do it. That just means they've got more negotiating strength when they sit at the table with China, which is they're coming back for negotiations this week. Doesn't mean they have to pull the trigger, but they have the authority to if they want to. All right. I do not see Trump. The way I've seen Trump play these financial markets, he plays it like a friggin' trader, and he's the president, which I don't like to see, but he plays it like a trader. So he knows, we all know we got the midterm elections coming up. I believe he's smart enough to know, and the Trump administration is smart enough to know, that if they throw a lot of tariffs on before the midterms, you're going to see the markets crash, and you'll see all the Dems coming up and bitching and moaning like they do, and it's going to be negative for the Republicans in the midterms. And I'm not talking Democrat or Republican. I'm not taking a side here. I'm just looking at where the market's going to react. So that is my reason. And also, by the way, the market's reason for just assuming he's probably going to hold off on these 200 billion additional tariffs before the midterms. Wait till after the midterms. That's the way the market price action, as I'm interpreting it, seems to be telling me right now. Okay. After midterms, I think he'll probably pull the trigger on it if they can't get any movement out of China. Um, and that's going to set the Dow down at least 500 points over the course of a week, at least. Um, if we take a look at other indexes, let's look at the NASDAQ. NASDAQ's been on a tear. Looking at NASDAQ, you can see here, it's regained its very steep trajectory, okay? The 50 EMA does not have the same slope as this trend line. I think this trend line slope is probably going to be broken again, and we're going to come down and test the 23, 20, or 7,400 zone. All right. Right now we're at for the NASDAQ 75, 74. So any downdraft in the markets, to me, I'd rather be short NASDAQ futures than anything else. I mean, we've seen some of the larger technology stocks, a little bit of profit taking. Again, we're still in a buy the dip. I've been telling our members we're still in a buy the dip kind of environment. Remember, I define it a little bit different than the rest of the markets. I define a correction like the market analysts do as a 10% pullback. I define a bear market like the rest of the market does as a 20% pullback. However, I break out less than 10% because from 0 to 10%, that's a long number. So I basically say a dip is less than a 5% pullback. A pullback is between 5 and 10%. A correction is what the market analyst and everybody else correctly notes as an official correction, 10% or greater, and then a bear market 20. So we've got in our group what we use for some of our trading is a dip, a pullback, a correction, and then a bear market. Okay, I think it's a little bit more precise, and it's worked out nicely for us in some of our trading strategies. So now you can see here, NASDAQ, we've got a lot of volume over price sitting around the 7,400 area. So that would be my natural inclination to see support and expect a dip and expect a long trigger. Should it break, then the next area is around the 7,250 area. 7,200, 7,250 in this shaded zone right here. And if we look at the Russell, index. Help if I could find it, wouldn't it? If we look at the Russell index, again, a very steep trend line. The trajectory, the arc of this is not quite as steep as the 50 EMA or the 200 EMA, which is what you would expect. So we're still full tilt boogie, guys. Buy the dip. That's what I'm seeing right now. If we look at the Dow Jones Transports, okay, which is kind of supportive of the Dow, look at this, guys. We made new all-time highs on Friday in the Dow Jones Transports. Trust me, In a weaker market, you're not making or not all time, sorry. You're not making annual highs in the Dow Jones transports in a weak market. And this also is giving lift to the Dow. Okay. We just, on this Friday, we were up 209.43. Typically, this leads the rest of the market. This suggests that November and December could be a relatively strong month, October too. If we do get strong earnings, and it's hard to believe we just finished Q2, we're coming up on Q3 here in another 2 or 3 weeks. If we get the same level of earnings, everybody's going to be pay attention to not what they do in Q3, but the forward guidance, because everybody and their uncle now is saying 2019 earnings are going to come in a little bit. We're not going to have the same growth story in 2019 that we had in 2018, which would mean still an upward movement in the S&P, but relatively shallow. Remember, I'm on record as saying I would be expecting a bear market sometime in middle to late 2019 into 2020. But, you know, we'll see how that thing works itself out. I think the outcome of the midterm elections is going to also influence the market and what sectors are going to be outperforming other sectors. So we'll start focusing on that for our members in another 60 days or so as we get closer to midterms. So you can see Dow Jones Transports also very strong. Now let's come over and look at the Vanguard All World Index. Remember what I said earlier. This is where we got the discrepancy. Look at this. We're still down for the year. We actually, like the S&P, the all world index corrected 14% in January, February. The S&P contracted or had a correction of a little over 10 or 11%. But the all world index never was able to lift up off the lows. In fact, it made lower lows from January. If we come back, you can see in January, these were the lows that were made in February for the all world index, around 51.98. And we're actually still lower than that right now. So the rest of the planet is not doing so good. And take a look at China. If we look at China, they're very ugly. Look at this. China is in a bear market. You can see here, let me just widen this out so you can actually see the print. China actually had their lows for the year back on September the 11th, earlier this week at 23.33. That was about a 33% pullback. So they're clearly in a bear market. If you look at their 2018 lows, our 2018 open price up here, China, of course, like the MSCI index, Asian index, as I said, the divergence is unsustainable. You cannot have the second largest economy on the planet in a severe bear market and the largest economy on the planet in a strong all-time high bull market without some kind of mean reversion here. Not in this time frame, not in this world with an interconnected market that we have right now, because money flows freely from country to country, from each of the top G7 economies. Money is just flowing freely. Right now, the U.S. is getting the benefit and money is flowing freely into here. But I do believe this is going to reverse. And for our members, we'll look at some of the creative ways that we can play this. I've already been outlining some ways that we can do it, playing, and this is something that over the next 6 weeks, we're going to start getting into a little bit deeper. There's going to be some great opportunities here. All right. So, and then look at the emerging markets, and we'll use the ETF EEM to just kind of look at a generalized view of the emerging markets. It was down in a bear market too. Now it's up, just slightly below a bear market, but look at the 2018 open price. Emerging markets are also getting decimated. I do not see any divergences, bullish divergences to the upside as well. So until we can break this channel to the downside and get a little bit of an open field running here, we're still going to be stuck consolidating down here. Okay. Now, what we could have is if the U.S. markets start to pull back a little bit harder, we'll see it affect emerging markets in the Asia Pacific region, but not nearly as severe as the U.S. Okay, just because they've already had a strong pullback to date. Okay. If we look at treasuries and we look at the bond market is already, keep in mind, we got the Fed's coming up with an interest rate decision here on in September in another couple of weeks, right? So they're looking at hiking the rates. There is a 97% probability on the 26th of Sept, probably towards the end of this month, 26th Sept, they're going to hike the rates another 25 basis points. And there's now also almost an 80% probability they're going to hike the rates on December 19th. So two more rate hikes for the year, and that'll get us up to about 2.5% for the year. So we're seeing, as I've been telling my members, anytime we get up in the shaded zone, you want to be long puts in TLT or short the bond market. Okay, I mean, that's the better trade. We're coming down to a major support area here around 140.28. I think we'll work our way back down here again. I do not think we'll break the 2018 lows. We may, but I don't see it at this point. If we do, there's going to be some open fill running in the bond market to the downside. So we got to watch that. And then if we look at the interest rates, look at the 10-year. 10-year is slowly moving back up to the highs that we made this year at 3.11.5, okay, 3.115%. So as bonds go down, interest rates go up. I don't see too much more upside in interest rates or too much more downside in bonds, because the numbers that we got for inflation this past week actually came in just a little bit. So that eases some of the near-term pressure on the Feds to be more aggressive in their Fed rate hikes. What people are going to be watching for the Feds this Sept 26th and then December 19th is not so much are they going to hike the rates then, because that's pretty much all but factored into the current prices. What they're going to be doing is they're going to be watching and listening to what's their dot plot and what is their prognostication for 2019 and 2020. I will remind every one of you that the Feds have never gotten it right as long as I've been tracking them over the past 2.5 decades, 25 years or so. They've never gotten the forecast right, ever. They've never been able to do that. The better market to follow is the bond market and the yield curve. And right now, the yield curve and the bond market is suggesting that inflation is just not around the horizon. They don't see it. That's why the short term of the yield curve is rising very fast. And the longer end of the yield curve is rising very slow, interest rate wise, on a percentage basis. So we've got to watch this very closely. We'll dig into the yield curve this weekend on our Sunday market watch. If we look at currencies, well, look at the dollar, guys. Had a strong Friday. All right. You can see here, remember what I was saying. I said the dollar is probably more, if there is any upside, it's probably going to pull back a little bit. The dollar is getting a little bit weaker. Okay, that'll help U.S. equities. It'll also help emerging markets. I don't see the dollar getting too much stronger than back up to this prior pivot high right here. We've had this 3-4-5 Elliott wave pattern, so I think we're going to go into a choppiness as we go into the Fed meeting here. Okay. Meanwhile, if we look at the euro is just, I was forecasting the euro to come up just a little bit higher and then run into trouble and then pull back a little bit. Not really sure if that's going to play itself out. Super Mario Draghi this past week came out and said they're going to stop their stimulus with their bonds, because they're still stimulating bonds to the tune of about 30 billion euros every month. But they're going to stop at this Q4. But he said they're going to run interest rates flat, meaning 0%, well into 2019. So that tends to be conducive, stronger dollar index, weaker euro. So we're going to see how this thing plays itself out here. Meanwhile, the interesting one I'm looking at is the British pound. You're seeing a little bit of a lift here in the pound. That's due to, the pound is going to be all about the Brexit. Remember, whether they have a deal or not, they're pulling away from the European Union next March. So the movement here in the British pound is all about the agreement they're trying to draft. Is it going to be a good agreement where everybody can agree to the terms of the deal? Or is it going to be a hard Brexit, meaning they can't come to terms and they're just going to pull away and let the chips fall where they may? So This downward move in the British pound was due to the fact that they thought it was going to be a hard exit, not a soft exit. We're getting some news that it could be a possibly soft exit. So again, this is another one of those currency trades that can be a little bit choppy in the near term. If it looks like it's going to be a soft exit, you're going to want to be a little bit more bullish the British pound. If it looks like it's going to be more of a harder exit, it's going to be bearish. Now, if you're as cynical as I am, then we're probably going to vote for a harder exit because I've never seen these politicians come to an agreement not only here in the US, but over in Europe, it's even worse. It's like it's worse than herding cats. So let's see how this thing plays itself out. Notice we got the 50 crossing the 200 to the downside. We got an upside resistance at the 200 EMA around 1.32. Um, so I just don't know how much more room we got to run here. I don't see too many longs coming into the pound until they get more clarity. They're supposed to have a drafted document in November. If there's word that that gets slid a little bit, you're going to see the pound sell off. Personally, I'd like to see the pound sell off down to one of these zones down here. Then I would be more willing to take a long position in the pound. Right here, it's kind of a neutral for me. Um, Gold. If we look at gold right now, I am still more bearish gold than bullish. I'm projecting gold to come down to around the 1150 area, take out the 2018 lows of 1167.10. Gold was down 14.77% for 2018. And I think anytime gold gets up here, I'd be more willing to sell it than buy it. We've got the 50 crossing the 200 here. The downward vector on both the 200 and the 50 are solid down. I'm also getting word that silver has gotten so low that we could see some buyers coming in. So we're going to watch this and see how this thing plays itself out. So that would be in the gold and the silver markets. Copper, meanwhile, is going along with China. For our members, I showed you the correlation between the Chinese markets, the yuan, and copper. They're highly correlated. So as long as China's in this strong bear market, we're going to see copper also in a strong bear market. So that's kind of where we're sitting here on this. Copper, I think, is going to be a nice play once we get wind that if they can get wind that this Chinese tariff deal is going to be resolved. Copper or one of the copper miners is where you're going to want to be. That's going to be one of the plays. Okay. Energy, oil. Well, with the oil market, our trade, the spread between Brent and WTI is coming along exactly as I forecasted to you guys. You want to be long the spread. But looking at just oil specifically, I think oil's near term is more down than up, even though we've had a little bit of an up run. I do believe near term for oil is down. Meanwhile, Brent, the near term is probably more up than down. You can see Brent is above its trend line here. And if we look at the spread between Brent and WTI, look at that spread. It's come up very strongly. I wanted to get long the spread right in this area here, right around 6.63, meaning Brent is more expensive than WTI by $6.63. Okay. It's $1,000 a point, and it's a nice hedged trade. And here you would be going long Brent and short WTI. But now we're starting to get a little bit of a peak here. A lot of this was caused by the Iranian fuel embargo. Remember, if they cut a lot of Iranian oil off the global markets, it's going to affect Brent much more than it's going to affect WTI, which means, if anything, Brent is going to move higher on a relative basis to WTI. That's why we've been long the spread. Okay. But let's see how this thing plays itself out. Gasoline, I'll tell you guys, I would rather be more short than long gas here. We're coming into the shoulder season. That means we're going in when refineries pull back a little bit and change over from summer to winter blend ratios of ethanol and the other crap that they mix in there that they send to the pumps. And that would suggest that gasoline is going to pull back. We also have higher than normal inventories of gasoline. The natural inclination of gas is to go lower. You can see these wide spikes here. We're making lower highs and lower lows, but it's just extremely volatile. A lot of that has to do with some of the hurricanes that have been blowing through and some of the issues with Iran, Trump releasing oil from the strategic reserves, and some of the lack of infrastructure build out moving gas or oil from the rigs to the refineries. But I do believe that near-term downside is better than upside in the gasoline market. Nat gas, a lot of people are projecting this to go a little bit higher. We haven't been in nat gas in a while. Inventories in the U.S. are extremely high. So it's going to take a huge cold winter. In fact, the Farmer's Almanac is predicting an extremely cold winter in the Northeast. If that's a fact, then we're going to see nat gas move a lot higher. But I'm a little bit leery of trading any asset primarily related only to the weather. I mean, weather forecasters, they spend decades learning to forecast weather and they still get it wrong going 1 week out. So what makes us think we can forecast weather any better? So right now with nat gas, I'm standing on the sidelines. I think nat gas is going to be a great play in the next 2 or 3 years when we build out our LNG terminals in the Gulf. And we start shipping nat gas over to the Asian markets and to European markets. That's when nat gas is going to be a really fun play. All right. Same thing with agriculture, with corn, wheat, soybeans. We took our win in soybeans and now we're back out. I think soybeans, I'm hoping it'll go lower because I'm looking for a lower long entry price in soybeans. Corn and wheat, we're also watching. These are just some of the things we're doing, guys. If you're not in our group, I highly encourage you to come in. Otherwise, members, I will see you this Sunday evening for our weekly market watch. Outside of that, guys, make it a great weekend. And I will be back at you next weekend for another weekly roundup. Take care, folks. Ciao.